Nobody really likes a bear market. The stock starts going down, everyone's investments start losing value, people start to panic. However, they don't last very long, and I'm going to show you guys 3 strategies that you can profit off of a downtrending market or a bear market. So strap in, because this one is going to be a barn burner. Hey guys, Corey here. Welcome to the channel. If you guys enjoy this content and you want more of it, be sure to subscribe and tap the bell so you don't miss great content like this, right guys? Right? That's what I'm talking about. Yeah, this is awesome. So you guys want to subscribe and tap that bell. Oh, and if you care about my feelings, or if you at least want to be generous, you can give me a thumbs up, as it greatly helps the channel grow. It's very big to understand a bear market and the difference and the risks that it poses in versus a bull market. Since the direction is now changing, you might think that there's no way to make any money, but that is not the truth. You can make a lot of money in a bear market, and I'm going to show you 3 different ways that you can make money in a bear market, and also a bonus way that you can print even more cash in a bear market. This is something that took time for me to understand and to hone my craft, but it wasn't always easy to understand. When I first got started in the market, I thought a bear market meant that we had to just hold positions and wait and lose money. But you see, there's so much going on in the stock market, which is why I launched my coaching, Discord, and full training course, because I want to help people. 5 to 6 years ago, I was pretty much flat broke. There was a time where I was flat broke and practically bankrupt, but I was able to turn it around. I learned the market. I was able to study it and get better over time and make money investing and to learn all the different tricks and tips and strategies there are in the market. And over time, I was able to grow my portfolio and achieve financial freedom. So now I can drive the cars I want. I can buy new cars every year, buy dirt bikes for me and my kids, have fun. I bought a new house, and next year or the year after, I'm going to buy another house. And I'm able to do these things because I achieved financial freedom. And I told myself, if I ever had the opportunity to achieve my goals of financial freedom, that I would help others, which is exactly why I launched the YouTube channel, which is why I launched my coaching, Discord, and my training course, and why I ultimately launched my full Masterclass bootcamp, which filled up in a matter of 3 days. So I launched another one, and there's only 2 spots left for that bootcamp. I'm ultimately at some point going to have to launch another bootcamp. If you guys are having trouble in the market and you are trying to achieve financial freedom and you just want to learn and get better, or maybe you're a complete beginner and don't even know where to start, I would love to help you on your financial journey, as it's ultimately what drives me is to help you achieve the success that you ultimately deserve. I'm trying to help as many people as I can, but you have to be very serious about your financial endeavors and really committed to want to get better, and I will help you achieve your goals. You guys can sign up at any time at investwithcorey.com, right there on the screen or in the information box below. You guys can see on the comments right there on the screen, everybody's making a lot of money in my Discord. I have given out lots of alerts in the Discord that have made money, like Wayfair, Rivian, Starbucks, Ford. We printed money on Ford, Soundhound, Palantir, SoFi. I'm sharing the Discord with you right here. You guys can see my trades, my gems, my announcement. Ask Corey. You guys have 24 access to me once you sign up. General chat for everyone, just hang out, chat about stocks. Day trading section, wheel strategy, iron condors, spreads, screenshot profits. You'll see here, I've got you can see here, someone made $30 on one contract, and then we've got another Discord member who's made a lot of money on SoFi, 40 cents at 1,000 shares, $400, and this only took one afternoon. I made over 500 on my Ford puts that I sold. Jesse has made a ton of money. He collected like a lot of money here. There's like over $1,500 in profits right here, and he's up $9 grand in 6 weeks. He's also a testimonial on my website. I will show you guys here, which I've showed people before. Over in general chat, I gave a trade for Ford, saying that Ford is going to be tanking and that we should be buying puts on Ford. You guys can see right here, 7/24, which if you look at the calendar, was last Wednesday, the day of earnings. 20 minutes prior to earnings, I said buy Ford puts to hedge. And then we go over to screenshot profits, and I printed like $500 on these 4 and another $300 on the other 4 puts. I made just about $900, or less than half an hour. And this is just one of the trades. I also put out a trade alert for SoFi about 3 weeks ago, and it was $6.39. It ran to $7.79. Jesse made $1.30 at 2,000 shares, $2,700 and change. He made in about a week and a half just on this one trade. He's up $9,000. So there's a lot of profits in the Discord, and not to mention the access to me, the full training course, the one-on-one coaching. I also have the Masterclass Bootcamp, so I look forward to seeing you there. So ultimately, the three ways that you can print money in a bear market are quite different. The first method is the hedged or collar position if you own shares of underlying stock, which is exactly what we're going to cover right now. Let's say you own 300 shares of Wayfair and you're afraid that we're in a down market and the stock's going to go down. This is what you would do. You would go over to your position on Wayfair and we would hedge our position by buying put, click on buy put, and we're probably going to go a month out just to make sure this down market is not going to hurt us. And so what we're going to do is we're going to go to the average cost. Now, since my average cost on Wayfair is $50.39, we'd want to buy 51 or 50 puts. You could buy any put you want, but we're going to go down to $50 puts. This is $475 per contract for the month. We're going to purchase that. Then what we're going to do is we're going to click on sell call, and then we're going to go out to the same amount of time, 1 month, and we're going to go up. So we're at $54. We want to lock in the $1,000 profit we got right now. So maybe we go to 55. We're going to click on 55. This is collecting a net credit of almost $400. We could probably get filled halfway between, which is around $450. So $450, we're going to collect on this call. And then when we click on buy the put, we are going to spend $475. So essentially, we're going to get a credit here of $74. So that's what's going to happen here. $74. If the stock tanks, we keep the $74 and we can sell all of our shares for $50. So essentially, we're going to make a lot of money, or we're going to get rid of our shares at a $75 profit. But we're not going to pay attention to that. We're just going to pay attention to the fact that it's $475 for the put, and the call is going to bring us in about $450 to $475. So we play our cards right. The put's only about $25. What this does, let's say Wayfair tanks to $40. Well, this is a $50 put. So if Wayfair tanks to $40, this put's going to be worth $1,000 plus the extrinsic time value. So if this happens in the next couple of weeks, it's still going to have a time value of half, because 2 weeks out of a month is half. Since we paid almost $450, actually $475 for it, it's still going to be worth about $250. So we could sell the put for about $1,250 to $1,300, meaning we paid $50.39 for Wayfair, okay? $50.39 for 100 shares, but then we can sell those shares for $40, which is $4,000. So we're out $1,039. But we also can sell the put for about $1,300, which now puts us $261 in the profit, plus the $475 it cost us. So we're only out about $200 because you have to pay $475 for the put. It decays down to $275, but then the stock drops to $40. It's worth $1,300 plus, maybe a little bit more. So we're out about $200, maybe $150, just depending on where volatility is. But then all we got to do is sell covered calls 1 or 2 weeks out. We made all that money back. We're at break even. That's what hedges our position. However, we sold the long call for $450. So now that we've done that, which is why we did it. Now let's take a look at what happened. We pay $50.39 for the shares. We pay $475 for the call, minus $450. Take a look at what happened. We pay $50.39 for the shares, $475 for the put, minus $450 for the call. We're all in at $50.64. Stock drops to $40. We sell at $40, $4,000. We're still at $1,064 minus the $1,300 we get to sell the put for. We're up $236 per share, or per 100 shares. So now we have $236 times 3 because I have 300 shares. I made $708. Right now, my profits are at $1,050. So minus $1,050, I'm only out $342 compared to where I'm at now. So I lost $342 of profit, but I'm holding, hoping the stock is going to go up, and this hedges my position. However, if the stock decides to run all the way up, let's say to $55, which is where we sold our call, we are going to collect $5,500 times 3, which is $16,500 minus $50.39 times 3, giving us a $1,383 profit, plus the 3 calls that I sold at $450 times 3, which is $2,733. So now I'm up $2,733 minus the 3 puts, $475 times 3. Again, I'm still up $1,300 even after a complete loss of the puts. So for me, I'm up $150, actually, $158 more than I am right now. However, we're going to divide this by 3. So if we're only doing 100 shares, you're up $436 plus that put at $55 is not going to be fully decayed. It's a month out. Sure, it's $475 That's what you paid for it. But once the stock goes to 55 a week or two from now, that put's probably worth $150 to $200. So even at worst case, we had 150. We made 586 if the stock goes up. So by selling the call, buying the put, it's almost free, virtually free if you get your balance right on the bid and ask. And if you play it right, sell your call as the stock's going up, buy the put as the stock's going up. This way it works in your favor. You get more for the call and you pay less for the put. So as the stock's going up, that's what you want to do. And if the stock goes up, you collect 586 per 100 shares, or times 3, 1758, which is $600 more than I'm making right now. If the stock goes down, you make a little less than I'm making right now, but you're hedging your position. This is how you make money in a bear market. I can go buy 100 shares of Apple right now, immediately buy a put right below the strike price, sell the call about $5 up. Watch, I'll show you right now. Apple will do the exact same thing. 218, we'll buy 218. We'll immediately buy a put going out to August 30th, and we will buy a 215 put for $600. We will then sell a $220 call for $600. You see, 680 versus 600. We could actually buy the 220. That's a little too much, but yeah. So we're actually going to make $80 profit to hedge our position. But if Apple drops to 200, we're only going to gain the difference between 250 and 210. So we're actually going to lose 300 minus the 80. We're out $200, but we can sell covered calls. It works the same. The only difference is there's a weird gap here. So let's go ahead and look at Tesla. Same exact thing. We buy the shares for 221. We're going to go out a month. We're going to buy a put, buy the 220 put for 1255. Then we're going to sell the 225 call for 1090. Basically $1,100. 1100 versus 1255. So we're at 155 bucks. Worst case scenario. The stock goes up. We're going to make money because we're going to make about 400 plus the money on the covered call. So even though we lost 100 between the call and the put, we're making 400. So we make 300. This is a very good situation. This is the caller strategy. Very good strategy in a bear market because these puts are going to print. If the stock drops, we keep all the juicy premium from the call and then we can sell the put for all the profits. And after it's all said and done, we're at break even to a small profit. Doesn't matter where the stock goes. For example, if Tesla was to drop to $200, the put would be worth $2,000. So even though we're losing $2,100, the put's going to print us $2,000. We're only out $100 plus the cost of the put itself. So we're out $1,300 minus the $1,100 and change, or $1,150 we get from the call. So we're only out $150. If the stock is at 200, we're just going to sell $205 calls, which would be the equivalent of selling a 230 call right now, or 225. So we're going to make about $1,000 to $1,500 in our first month. If we get assigned, we made the $1,000, $1,500 plus the $500 on the shares. So worst case, the stock drops, we sell the put, we buy back the call at $1. We're only out $100. We sell a covered call going $5 out of the money a month out. We're now $1,500 up even if we get assigned. This is how you make money in a bear market. But the caller strategy isn't the only way. You can just straight buy puts on your favorite stocks. You can buy the puts without selling the call. This way, if the stock runs, you make more profit, but it's a bear market and we're not expecting the stock to run. That's why we're selling the covered call, because we know we're going to collect it. The stock is going to drop. The put's going to print juicy premium. It's going to print lots of premiums, and the juicy premiums we collected from the covered call are going to erode immediately. Oh yeah, the stock's going up. It's going to go up. Let me collect your money on that covered call. Don't worry, the stock's going to go up. Trust me. Thank you very much. That stock's going up. It's definitely going up, right? Of course it's going up, but then it doesn't. And we keep all of that juicy premium. The stock tanks. We get all the premium from the put. We sell it and we're at break even on the stock itself. So we hold the stock long term. When it goes back up $10, $20, $30, those thousands of dollars and all those covered calls are pure profit. This is the #1 strategy, and a much better strategy than just straight buying puts. If you want to buy a put on a stock you don't own, let's say Tesla, you want to buy a 210 put, well, you can also sell a call credit spread. You can go up here to say 230 because we believe it's in a bear market and Tesla's going to go down, or a 235. Sell that a month out. Go ahead and buy the 245. We put up $1,000 collateral and collect $260 juicy premium. This covers a quarter of the put. But if we truly believe this is a bear market, we could put up a couple of grand more. Maybe we could sell 4 of these and collect $1,040. This right here, almost enough. If we sold 5 of these, put up $3,700 of our money and collect $1,300 juicy premium, we now buy the put for free on Tesla and don't need the stock. So we don't need $20,000. We only need $3,700 to make $1,300 this month on Tesla. And that $1,300 covers the cost of the put. So we're at break even with this spread and the put. The difference here is that we don't need to own the shares. And as soon as the stock starts going down and drops another $10 or $15 in the first week or two, this decays. We keep all of that profit. And now our put starts printing. swing. So when the stock goes from 220 to say 200, the put's now going to be worth like $2,000 more than we bought it for. So in this particular case, the put's 1,300. It's going to be worth about 3,200. So now we sell it. We make all that profit. We get out of the short position on the call we sold, 50 to 80% profit there, which means we're up. Let's look at the calculator. We collect 1,350 from the short call. The put cost us $1,255. Now we're up $95, but then we sell the put for $3,200 if Tesla drops to 200 bucks. Here's how awesome this is. We collected $1,300 from this position on the short call. Then we spend the $1,255 on the put, leaving us a profit of 45. The stock drops to 200, giving us a value roughly of 3,200 on the put. We now add 3,200 back. We now profited $3,245. We actually made $3,245, and yet we did nothing. We just took advantage of a bear market, the stock going down. The put made us $2,000 profit plus the $1,300 on the call. So we made $3,245 or $3,300 in a month or less. And all we needed to make that was $3,700. So we doubled our money. This is a 100% return on a bear market. If you guys enjoy these strategies and you want more of them, you guys definitely want to think about my training course, full Discord, and one-on-one coaching, and my Masterclass bootcamp. I have a full 4-hour course dedicated to teaching all the different strategies similar to this. This is just one or two ideas or one or two strategies. This is just a couple of the dozens and dozens and dozens of strategies that I teach in my training course and my coaching. So if you guys are looking to become profitable, or you're a beginner and don't know where to begin, I would love to help you achieve the financial freedom you ultimately deserve. You guys can sign up at any time at investwithcorey.com, right there on the screen or in the information box below. I look forward to seeing you and helping you achieve the success that you ultimately deserve. So these are the two different ways, the caller strategy or the credit call spread or the call credit spread. So you can do both of these. They both work. There is one more strategy that you can run. Robinhood does not allow this, and that is shorting the stock. Now, I don't really talk about shorting stocks that much because ultimately it's a little bit risky. But if your brokerage allows it, you can actually sell the shares where they're currently at, collect a credit, wait for the stock to drop, and buy them back. For example, Webull does allow this, and you'll see it'll say short, sell, and buy, or buy, sell, short on certain stocks. So open up my calculator. You would then sell, let's say Tesla, 221 times 100 shares. You'd collect $22,100 minus, let's say if Tesla dropped to $210 minus 210, you'd buy it back for 210 times 100 shares. You'd be left with $1,100 profit in a week, couple of days. But this is shorting, and there is good profits in shorting, but it is unlimited risk because if Tesla just keeps going up and up and up and up, your loss gets bigger and bigger. So you have to be very careful about that. And as soon as you see a rejection where Tesla or the stock you're shorting starts to go up, get out, profit, a break even, or a small loss. Ultimately, the caller strategy, the first one, is the best one. The second one is very good as well. Shorting is highly risky, and you have to be sure that the stock is ultimately going to go down the way you think it is. But you can also buy puts, but I'm not really big into put strategies. But if you must, the bonus tip for this video, I'm going to show you on Meta. Let's say you think Meta is going to go down by the end of August. Let's just say you think Meta is going down, but you don't want to buy a put for $470 because you don't have $3,000 to do this. Well, you would buy a $470 put, and then you would sell a $460 put. Then it would only cost you $500 to make $465. So essentially, you're doubling your money in 1 month. Put up $500 to collect $500, you turn $500 into $1,000. This is a very powerful strategy. However, you could also sell the $465, meaning it's only going to cost $252 to make $248. Again, you're doubling your money. But if you think Meta is really going to drop, what you would do is you would buy. So I'm going to show you this strategy on Meta. Let's say you think Meta is going to go down to $480. So let me show you this put strategy on Meta. Let's say you think Meta is going to drop to $460, but you don't have $2,500. Well, you're going to click on buy, then click on sell, and you're going to sell the $450, $10 down, $1,000 spread. Putting up $470 to make $530, doubling your money. Putting up $470 to make $530, turning it into $1,000. This is over 100% return in 1 month. You can do this the other way and also sell the $455, so it's a $500 spread, and cost you $275 to collect $225. So again, pretty much doubling your money. However, if you think that Meta is going to drop even further, it's even juicier to go further out of the money. We could buy a $430 and then sell a $420, putting up $263 to make $737. This is a 4x return. This is a 400% return. If we were to do 2 of these contracts, we'd be putting up $500 to make $1,500. Just like I said, said, 3 to 4x return. And all Meta has to do is go down to 420, which is highly unlikely at this point in time. But in a bear market where everything is starting to really tank, you can see how much money you could just straight print. Like in this situation, if we were really confident, I could run 10 of these, put up 2,600 to make 7,000. This is turning 2,000 into 10,000 in a relatively short amount of time. You could run the put debit spread, which is this scenario right here, to print ridiculous, stupid premiums in a bear market. So you could run the hedged caller strategy like I showed you first. You can buy put. You can also short the stock, and you can sell put debit spreads just like I showed you right here. The options are yours, literally and figuratively. In a downward bear market, you can make money off of this scenario because ultimately it's a greedy time. When the market is fearful, you should be greedy. So in a downward market like this, I would be buying shares, dollar cost averaging, and running the caller strategy and buying puts and printing ridiculous premiums. Yeah, because we know the market's not going to go down forever. So I'm going to take all of your money on the way down, and then after I sell out of the puts, I get to keep all your guys' money. And then when the stock starts going up, it's all pure profit for me, which we know is inevitably going to happen. I'm sorry, I didn't create the rules or make them. I'm just playing the game, you know? Just playing the game. Don't be mad at me, guys. Hey, I didn't invent the game. I'm just playing it. Don't hate the player, hate the game. And it's all about how you play it, essentially. That is really the analogy here. The market's going to recover, buy everything up, sell puts, call a strategy, hedge, make money on the way down, then add it all up when it hits a resistance. And then as all the stocks start going up after you've sold your puts and your short calls are all expired, all those juicy profits from the stocks are yours. So you guys can see how powerful this strategy is in a bear market. When the market is going down, you are collecting premiums from the calls that are decaying worthless, and you're collecting profits from the puts that you bought. And when you sell them and you buy the calls back, you are holding shares for free or a small profit, which you're just going to print returns on when the stock market recovers. It is the ultimate strategies to run and to make juicy premiums in a bear market when everybody is fearful and you're the greedy one. Thanks so much, guys, for being here. If you enjoy this video, be sure to subscribe, tap the bell, and give me a thumbs up, as it greatly helps the channel grow. And if you guys want to learn more about the stock market and you are looking to better your knowledge and grow your wealth, I would love to help you grow your financial freedom and teach you all of the strategies you need to learn and you need to know to better your financial health and wealth. You guys can sign up at investwithcorey.com right there on the screen or in the information box below. It drives me every day to help everyone just like you achieve the financial success and freedom that you ultimately deserve. Thanks so much, guys, for being here. I know this video's over, but don't worry. I picked out another video just for you, and that video is right here. Click that video. You guys are going to love it. It's just as good as this one because I make awesome videos, right, guys? So click it. I'll see you over there. And remember, until the next video, let's grow our wealth together. Take care, guys. You're still here? Click the video. I'll see you over there. It's awesome. There you go. Attaboy. Click it. We'll see you over there.